Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome to today's podcast. Thanks so much for coming back, tuning in, whatever it is, however you got here. I very much appreciate it. If you guys are liking these podcasts, please leave a review because apparently podcasts are ranked by reviews. And if there's a lot of reviews, then people can find you better. And we all know you farmers need as much help as you can get. So today I'm going to talk about loans. And it is pretty crazy how many questions I have got in the last week about repaying the loan with more interest and what happens. And I am almost certain that I have talked about this on another podcast, but people that are even listening to my podcast are asking the question. So if this is repetitive, I apologize. But apparently it needs to be addressed again. And so while we're on that topic today, I think we'll also talk a little bit about repaying things you've paid cash for. So let's talk about loans. Nelson talks about it in his book. I talk about it in my book. If you are going to take a loan from the insurance company and you're going to pay extra back to yourself, where does that money go? And should the policy be built to hold it? So let me be very clear here. There are two parts to this policy. There are premiums and there are loans. If you're taking loans, there are two parts. They're two separate, I don't even want to call them parts, but they're two separate things. Let's say that. They're two separate things. Premium buys death benefit. When you take a loan, you repay the loan and you pay interest. Now, some people think, and some people have been misled in the infinite banking world, that when you take a loan, you make money. You don't make money when you take loans. In Nelson's book, he illustrates if you pay more interest, what happens, and the cash value grows. So people tend to think, oh, you make money taking loans. You make money paying premium. And I'm not going to go over that. So go back to the podcast that I did about loans. I don't remember which one it was, but go back to that podcast and pay attention to that. So if you are going to be an honest banker, you need to pay yourself what the bank would have charged you. Now, that's what Nelson says. In today's day and age, when we have 1.5%, 2%, 3% interest rates, and the insurance companies are charging anywhere between 4%, 5%, 6%, what do? Do we pay back? Do we go to the bank? Do we pay back even more? If we could go to the bank and get a 2% rate, and I'm borrowing from a life insurance company at 4.5%, do I pay back more than the 4.5%? Because I could have went to the bank and got 2%. Now, you got to use a little imagination here. If you are going to borrow from your policy at 4.5% and the bank was going to charge you 2%, then you get to decide if you want to pay back more. If you pay back more than the 4.5%, it's basically forced savings, but it can't go into the policy as a loan repayment. Okay, anything over the 4.5% isn't going to go in as a loan repayment because you've paid back the loan. So you're going to have to put it in as premium. It's going into the policy as a premium payment, not a loan repayment. Let's say that your policy is $10,000 a year of premium. You've already paid the $10,000 for the year. But now you have another $1,000 of interest on top of what the insurance company is going to charge you because you decided you're going to pay yourself back more. Well, what are you going to do with that extra $1,000? If the policy was not set to hold it as premium, you can't put it in as premium. You're going to have to either start another policy, put it in a savings account. When you start your policy, if you're going to be an honest banker, you can start it with the intent that I want a little bit of extra room in there so that I can pay back interest. Okay? But then you have to do it. You don't want to start a policy with a $15,000 limit and you only put 10 in it. I mean, you can do that, but it's not going to maximize the cash value. So if you are wanting to pay back extra and be an honest banker, the extra money is going to go into the policy as premium, into another policy as premium, into a savings account that you are holding until you can start another policy. And then when you're ready to start another policy, guess what? You have some extra money to put in right away. This is super important because we're not getting rich taking loans, right? We're not creating extra wealth by taking a loan. We're creating the extra wealth by being an honest banker and paying back more interest than what the insurance company is charging us. Is there something wrong with paying back a loan at 7%? Absolutely not. Just like there's nothing wrong with charging your kid 10% interest if he wants to borrow money, because it's all coming back to their estate anyway. So if you're charging yourself 7%, what does it matter? It all goes back into your pocket. It's just a different pocket. You get to use it. Then the question comes, well, what if I can't afford 7%? What if I can't afford 4.5%? Then you probably shouldn't be taking a loan, right? When you're taking a loan against your life insurance policy, that is no different than if you were to go to the bank and take a loan from the bank. If you wouldn't be able to pay the bank, you wouldn't take the loan. If you can't repay yourself, don't take the loan because you can't afford it. Put your banker hat on. You have to think like a banker. Would you lend money to yourself? How much interest would you charge somebody that came into your bank? The more interest you charge them, the more money you make, right? Because the bank makes money off of interest. So if you charge yourself 7%, then great, you just made more money. It's not magical. It's just putting more money into savings. It's being disciplined. It's beating Parkinson's law and doing something different than your peers are doing. But if you can't afford a 7% loan payment, then you don't have to pay yourself back 7%. But like Nelson said, how are you going to beat your peers? How are you going to come out ahead? You just stretch your payments out because it's to yourself and you can do that. And remember, when you take a loan, when you are borrowing money from your policy and you're paying it back, you then have that money to use again for whatever else it is that you want to purchase. So if you're paying it back and now you have access to it again, it is a payment that acts more like a deposit because now we have access to money again. Yes, you can use a savings account all day long. I could care less if you buy a policy. If you don't understand the policy part of this and you just understand the savings account part, fantastic. If you've got $10,000 in savings, when you take it out of savings, pay it back to savings plus interest. You're going to have more money to borrow against. The reason we're using the policy is because it never actually left our account. Our $10,000 sat there as collateral, earning compound interest and dividends that the insurance company is paying us. So when we're borrowing money and we want to be honest and pay it back for more, Go ahead, do that. Here's another thing. If your operation is an LLC, an S Corp, even an LLC doesn't matter. But if your farm is an S Corp or a corporation, or you have a partnership and you personally own the policy, you can lend money to the S Corp at 7%. So if you're lending your S Corp $10,000 at 7%, the S Corp, according to my accountant, can write off that 7%. Now you need to keep your documentation, right? Because if you get audited, you're going to want to make sure you have that. So now you're writing off, the S Corp is writing off the 7%, but the 7%, you are paying yourself back the 7%. The insurance company charged you, say, 4.5%. Anything over 4.5%, you have interest income. So if you're going to charge your corporation 7%, that's great. Now we've got a tax write-off for the interest on the S Corp side, but we also have to remember that anything over what the insurance company is charging us for interest is interest income on the personal side. So if you're going to deduct it on one side, you better take it as a gain on the other. And you have to for tax purposes. You can't just say, I'm going to charge myself 100% interest on my S Corp and I have this huge deduction. Well, okay, you just forced more savings is all that you did. And now you have interest income on the other side. I mean, be reasonable about it. You're not winning when you charge yourself 100% interest. Because then we think, oh, we've got all this interest to write off. Yes, but you're gaining it on the other side as interest income. And there are some benefits to interest income. But mathematically, just make a bigger premium payment. I mean, it's just that much more forced savings. So if you say I can pay 100% interest on all my loans, then just start a bigger premium and it doesn't necessarily have to be interest. There are also state guidelines that say how much you can charge on personal loans. So make sure that you're checking with your accountant on all this stuff. Some accountants will say, no, you cannot deduct the interest from an insurance policy loan. My accountant says it's not a big deal as long as you have the documentation to prove that, yes, I borrowed $10,000 of cash value and I bought, 5 cows with that. Okay, great. Now you have the documentation that you bought those cows. You bought a piece of equipment. You bought whatever it is that you bought. But if you're going to deduct the interest, you better have the documentation in case you get audited, that that's what you use that cash value for. Here's another thing that I want to touch on is if you are buying things with cash, you need to pay yourself back. If you're making large cash purchases, you need to pay yourself back plus interest. Because not only did you take that money from your checking account or savings account and lost the ability to make interest on it, if you don't ever use a policy, you need to at least pay yourself back plus interest. So I have had clients that are saying, I spend at least $100,000 to $200,000 a year with cash, or I spend $500,000 a year in cash. Do you ever pay yourself back for that cash? If you've spent $100,000 and bought a piece of equipment with that, or used it as a land down payment, you need to figure that in as your payback. You don't get to just say, oh, okay, well, now it's gone. No. If you made a land down payment and you finance the rest of that land at the bank, you have a bank that you have to pay back and you have yourself for the down payment. And you get to decide how that gets paid back, but pay that back to your savings account plus interest. Charge yourself 5% interest. Well, I can't make that. Then stretch the loan out. Be honest, if you're paying 5% interest on the land, why aren't you doing 5% interest on the down payment? And remember, it goes back to your savings account. Now, ideally, anybody that comes to visit with me and they say, oh, I just bought $100,000 worth of stuff with cash or $50,000 worth of stuff with cash every year. Okay, then it sounds to me like you need to pay yourself back and that becomes your new premium payment, right? Or if you're spending that much cash every year, does that first go into a policy? And then we borrow from the policy and we pay the policy back. But if you've already spent the money, put that back into a policy and pay yourself plus interest. Well, Mary Jo, how do I document that? That's another question I get a lot. Well, you document it by putting it in your QuickBooks. If you're keeping your books and you have all the loans that you owe the bank or Case IH or John Deere or CHS or whoever it is you're making payments to, if you have all those loans laid out in your Excel spreadsheet, in your QuickBooks, I don't care what system you're using, then you need to put another line item on your loans that you owe yourself X amount of dollars for this loan. And you can go online, you guys, anywhere, type in amortization calculator and a calculator will pop up. So you know what your payment would be to yourself at whatever interest rate over whatever time. Plug the numbers in. Create the amortization schedule. Again, put on the banker's hat. Think like a banker. What does he do when you come in? He doesn't just say, oh, okay, well, it's going to be approximately this much every year. No, he puts it in his amortization calculator and figures it all out because he wants to the exact penny. You need to know to the exact penny. So you need to do the exact same thing. Put it on your list of loans that this is what I owe myself. And if you owe yourself for 3 or 4 different things, great. But we just spend cash and we don't ever pay it back. And I say we because I'm not perfect. I do the exact same thing. And it's the hardest thing ever to get into is that piece right there. But even if you paid yourself back extra interest, guess what? You just have more money in savings. You just have more money going into a policy. I think that should clear it up. I hope that clears it up and that makes sense. But that is why Nelson had 49 policies, is because he borrowed and paid back more than what the insurance company was charging. He was honest about it. It was just creating more wealth in his system. And he was not as scared of payments, right? Because he knew it wasn't necessarily, it was a payment on his books, but it was all coming back into his pocket. And he got to use it. And so that should clear all of that up. And if you guys have further questions on it, I'm obviously happy to answer those. But in the meantime, let me know if there is anything else that I can do. MaryJo@withoutthebank.com. Christmas is coming. So if you need a book, go to farmingwithoutthebank.com, grab a book. There is also, we are doing a special right now if you add a book on. So go to farmingwithoutthebank.com. You will see that my other book that I wrote, we've got a special on that. And you can just add that on in the meantime for Christmas. Okay, you guys, you have a fantastic day. And I will catch you on the next podcast.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.